This past Thursday, President Donald Trump signed an executive order that could allow Americans saving for retirement to bulk up their 401ks with things other than cash and equities. They include alternative assets like cryptocurrency, private equity, and real estate. For more on this, I want to bring in Jonathan Schaefer, co-founder and CEO of Fission Labs, a blockchain services company. Jonathan, welcome.
Kristen, thank you so much for having me. I really appreciate being here.
Yeah, great to have you on the show. And this news, as I mentioned, coming out late last week. What does this mean for Americans?
So I think it's a big opportunity for Americans to have access to higher yielding products. And traditionally, they've been stuck in U.S. equities and debt. And those are, on average, 8% yielding products. But if you want to give them opportunity to earn kind of 10% plus, they're going to have to move more into these esoteric asset classes like private real estate, private debt, private equity, and crypto. And there's $9 trillion of retirement savings in 401ks right now. So any capital flows from that into the private markets or the crypto markets could really be material to the price of these assets.
Mm-hmm. So let's start with cryptocurrency then. Where do you see that asset heading?
So I would say simply up. And the reason is you've seen like the first evidence of sustained buying. The ETF inflows are now 100, 150 billion around that magnitude. If people start taking even a fraction, 1% of the 9 trillion in 401k savings, and that's also repeat buying, right? So on a routine basis, it provides some buy pressure. I think the answer is up.
Mm-hmm. So we currently see Bitcoin, I think, trading at, let's just say, 110,000, 119,000 per token. Thank you very much. So right near, in fact, that all-time high, pretty consistent with the equity market. I think our viewers by now probably do have a good sense of cryptocurrency. We'll wait to see if it does get more mainstream adoption with this particular rule. What about private equity? For an investor who's watching this and wondering, how could I get exposure to that? What does that type of exposure look like? What would you tell them?
So I think it's principally funds, right? And the big players in this space that offer, retailer accredited focused funds are like the Blackstones, the Apollos, the KKRs. These are assets that often return 10% plus. They're lower volatility than public markets. Over time, even another 2 or 3% of annualized return, that can really compound into meaningful improved savings, the ability to buy a house. And so I think investors can't ignore this. I think the one thing they should be cognizant of is these tend to be slightly lower liquidity. So you can't trade out of it on a day-to-day basis. They may have some duration of lockup or fees associated with taking your money back. But over time, should they be allocating to their portfolio probably 10+% into privates to get that, enhanced return? I think so.
So what sort of mindset do our viewers need to have when considering these sorts of investments down the road and knowing that there could be the chance potentially for more volatility?
So I think first, you have to start getting in the game, right? So you have to do some research, figure out what type of private, PE, VC funds based on your risk tolerance. The VC tends to be the higher end of the risk curve, real estate can be on the lower end of the risk curve, so you kind of have to think about your own risk. The second part is you have to take a long-term view, right? These are not assets that are traded on a daily basis, they're not marked on a daily basis, so as long as you're comfortable sitting in them for years, they can really help you aggregate, higher returns.
So to that end, would a younger investor, right, maybe be more ripe to add one of these to their 401ks, perhaps than, someone in the baby boomer generation that is looking for a more stable income?
I think that's exactly right. And particularly like if you have a nearer term cash need, you don't want to be entering a longer term instrument. But for younger people who are just starting to save, getting exposure to these, now more mainstream PE VC funds, I think you have to at this point. Having a little bit, at least a little crypto exposure, if not a little more, I think you need to do that as well, just given how the market's going.
What is a little these days? 5%, more or less?
I'd say in alternatives generally,
yeah,
probably at least 10%, but that's splitting across, PE, VC, RE, and crypto. I'd say crypto, at least a few percent.
Okay, and what else do our viewers need to know about this rule?
So I think it's not finalized yet, right?
Yep.
The Department of Labor is reviewing it, the SEC is reviewing it, but I think you have an administration that's dedicated to expanding, and democratizing access. So I'd say keep an eye on this. You don't want to be too late on this, right?
Yeah.
As inflow, you don't want to miss the train. But you want to be, depending on your approach, you want to be conservative and not over allocate to these assets if you're not prepared for the risk.
So it sounds like maybe the right approach is, talk to your advisor about this, or perhaps your 401k servicer.
Talk to your advisor, talk to your 401k servicer, do some research yourself on the funds, their performance, the volatility, what's your potential loss. Think about what you're willing to lose and don't bet more than that.
All right, Jonathan Schaefer, he's a co-founder and CEO of Fission Labs, a blockchain services company. Jonathan, thank you.
Thank you so much for having me.